Welcome back to another video. In today's video, we're going to be covering UnitedHealth Group Incorporated. Recently, they dropped 46% from their all-time high with some fraud allegations and some other pretty heinous allegations were uncovered by different media news outlets. A lot has happened. Everybody is spitting out UnitedHealth Group. And we're going to look at the company to see if people are overreacting, how the company is looking, and if right now is a good time to buy the company, or if we should avoid catching this falling knife. So with that said, we're going to go over to the video. If you're new here, subscribe down below. I would love to have you in my community. And we're going to go over UnitedHealth. So right now I'm using FinChat. I use this for all my fundamental analysis and keeping up with the earning calls. If you do want to use FinChat, my affiliate link is in the description. You can try this platform for 2 weeks without using your card. That said, we're going to go over UnitedHealth. So we are looking right now at the premiums, annuity revenue, and the policy benefits. We have to look at these the same because they correlate. So the premiums and annuity revenue, that's basically revenue coming in from all the money that's paid on the policies they're extending to people using UnitedHealth insurance. And the policy benefits is what they have to pay out to the people in damages and compensation for going to the hospital or having some type of surgery. Then they have to pay that policy. So as we can see here, they've both been growing. Of course, as your premiums and annuity revenue grows, your policy benefit grows as well. The difference here is we would like to see a discrepancy between what they're getting, so the premiums, and the policies that they're paying. So we can see here, if we look at the CAGR, we can see that the premiums and annuity revenue is growing at a 10.40 CAGR, and the policy benefits is growing at a 10.96 CAGR. So policies is growing a bit faster. But if we look at the policy or the premiums to policy ratio, we can see that in the first, it was 1.22, then 1.23, 1.21, 1.26, 1.21. It has been going up and down. But in the last quarters, it has only been going down. So here it was 1.60, here it was 1.16, and here it was 1.16 again as of the latest 12 months. So we see that the premiums to policy revenue, the correlation there, it's getting smaller. Ideally, we would like to see this getting better. Why? That shows us that the risk management from UnitedHealth is getting better as well. As of now, there's of course no trouble here. They are bringing enough premiums to cover their policies, and we'll cover one more thing that will cover these policies as well. So as of right now, it's good. They're at a 1.16 policy to the premiums to policy ratio. I would like to see them rebound back to the 1.25-ish range. I think that's a more healthy range for UnitedHealth to be in. Right now, in the last couple of years, we do see a small decline in this ratio. So I do hope with the new CEO coming into place that he's going to fix this ratio. As the ratio increased, the policy or the premium to policy ratio, that shows us that there's better risk management on UnitedHealth's side. The next thing we're going to look at, what's also paying the policies that UnitedHealth has to pay, is their total interest and dividend income. So as you can see, they've been growing their investment portfolio. So they have been growing their interest and the dividends they are receiving. This portfolio is primarily composed of fixed income securities like government and corporate bonds. They invest in these, they get their dividends and their interest, and they use this revenue source, to also contribute to the policies they have to pay out to the policy holders. So overall, there's a good revenue growth. They are growing their investment portfolio. We'll get to that in a bit. So the ratio I just mentioned is a little bit bigger because of the interest and dividend income, but still the ratio is not, I would say, optimal for UnitedHealth. They've been at 1.25. We would like to see it at 1.25 again. That shows good risk management, because if we look at the premiums and the policy in isolation, the risk management there, it is declining, and we do like to see that risk management on UnitedHealth side is going to get better. The next item we're going to look at is the non-insurance activities expenses and the non-insurance activities revenues. So this revenue is all Optum. You have Optum Health, Optum Insights, and Optum RX. I'm not really expert on the American insurance system. So I do have it noted down on what it exactly is. Optum Health delivers patient-centered care, care management, wellness, and consumer engagement, and health financial services. Optum Insights offers data analytics, research, consulting, technology, and managed services and solutions. And Optum Rx provides diversified pharmacy care services. Those three Optum segments are the non-insurance activities, expenses, and revenues. And as we can see, they've both been growing consistently year over year. The expenses have been growing with a 12.46 CAGR, and the revenues have been growing with the 12.47 CAGR. So they're growing in line. So what also does this tell us? That the margins of this business are very stable. Of course, you have Optum Insights. It's a data platform. It has way better margins. Optum Rx has a little worse margins because there's more overhead cost attached to it. And Optum Health, pretty much the same. But what we do see here is that it has been stable. So as the costs grow, the revenues grow in line as well. If we see margin expansion, we would see that the revenues would outgrow the expenses of Optum. Next, we're looking at the interest expenses. UnitedHealth Group has a very hefty, a very robust balance sheet, but it's loaded with a lot of debt. And we'll cover what the debt primarily is in a bit when we head over to the balance sheet. But as you can see, a lot of interest is being paid year over year because they have a lot of debt on their balance sheet. And if we're going to compare this to their total revenues, we can see that in 2015, 1% of their total revenues was heading towards interest payments. And as of right now, as their revenues have grown, their interests have also grown because they took on a little bit more debt. But we can see that revenue has outgrown the amount of debt they're taking on. So the interest they are paying is getting more. Yes, it's getting significantly more, but it's still 1% of their total revenues. So overall, their revenues are far outgrowing their long-term debts. And there's no true burden of this interest. Yes, 1% interest compared to your total revenue, it's a lot of money. And we rather see limited debt or no debt on the balance sheet because all this interest, if you look on it on a cash basis, 4 billion in interest, as you can see, if it moves right here, 4 billion in interest, that's a lot of cash, that's a lot of capital, and you could allocate it fairly well, especially in the insurance sector to improve. They could allocate that 4 billion towards Optum to optimize the efficiency of all the programs they're using. So there's a lot you can do with 4 billion. So it's sad to see that it's going to interest. But again, it's only 1% of their total revenues. They have a lot of free cash flow. They have a lot of operating cash flow. And from that operating cash flow, they can start reinvesting back into the business as well. So yes, it's a shame that 4 billion is being paid in interest as of the latest 12 months. But again, it's not a big deal. It's 1% of their total revenues. Looking over at the shares outstanding for UnitedHealth, we can see that in 2015, they started with 967 million, and they've decreased that all the way down to 928 million as of the latest 12 months. So we do see that UnitedHealth is buying back shares, and this coops back to the debt because UnitedHealth Group is using a lot of debt to finance these share buybacks. So although they're taking on more shares, they are creating value, or they're taking on more debt. With that debt they're taking on, they're creating more value per share for us. And they have a very robust balance sheet. We'll go over it in a bit. So it's not really that worrying that they're financing share buybacks with debt. Of course, ideally, we would like to see it in a different way. Just efficiently using your operational cash flows to finance share buybacks is a way better option. Issuing shares to get equity, always a bad option. And using debt for share buybacks, it depends. They have a very robust balance sheet. So right now I'm not really worried or skeptic about it. But we would rather see other types of cash flows being used for share buybacks. Nevertheless, they're creating more value per share since they're reducing the outstanding shares in total. So that's a very good sign here for UnitedHealth. Right now, we're looking at the balance sheet. We're looking at the total other investments. So this is the investment portfolio I was referring to, the investment portfolio where they're receiving interest and dividends from. And as we can see, their overall portfolio is growing. So we could expect that the interest and dividend they are receiving from corporate and government bonds will increase as well. And this will add to their liquidity. They'll be having more interest and more dividends. If they have more interest and dividends, they'll easier pay the policies they have to pay to the people who underwent surgery or had to be transferred to hospitals or had to get some type of medication. As their portfolio grows, they're more liquid and they're easier, or they're in a better position to pay those policies. So that does add a little bit to their risk management. But again, the premiums to policy benefits, the ratio, we would like to see that better in the long term, and them not having to focus as much on their investment portfolio. But again, this adds some value, it adds some certainty, it adds some liquidity to the business. Next up, something I always look at is cash and cash equivalents. I love a company that has a lot of cash on its balance sheet. So if we are going to compare this to their revenues, their total revenues, I usually strive for a company that has roughly 5% of its revenues in cash reserves. A cash reserve just gives you some cushion for an economic downturn, or something happens, or you need to invest something, or a very good acquisition suddenly pops up and you can use cash. So UnitedHealth is an insurer. So I do require insurers to have a little bit more cushion. So I strive for roughly 8 to 10%. And we can see that since 2021, UnitedHealth has had roughly 8 to 10% of its total revenues in cash form on its balance sheet. And that's very good, because in the insurance sector, when something happens, a black swan event, it's very, very good to be very liquid and have a lot of cash on your balance sheet to cover any unexpected costs or unexpected headwinds. They have 10% of their total revenues in cash, so they're very liquid and they will face less trouble compared to their peers. So that's very good. They have a lot of cash on the balance sheet, and that provides a cushion, like I said. Next up, we're looking at the goodwill. So goodwill, that is basically, let's say a fair value of a company you're buying is 1 million and you pay 1.2 million. So the $200,000 you're paying extra, that's goodwill. So that's short, the premium you're paying on a business, that's the goodwill. And UnitedHealth has done a lot of acquisitions. Crystal Run Healthcare, Medicis, LHC Group, DaVita Medical Group. They've done heaps of acquisitions to make their operations more efficient. And we can see it on their balance sheet. It's all reported in goodwill, paying more and more and more premiums. And I am not a big fan, because their goodwill to asset ratio will be relatively high. Goodwill does not amortize. Instead, it gets tested annually or when triggered for impairment. But a surprise write-down could hit earnings. So having heaps amounts of goodwill, if some impairment happened, that will impact the earnings. So I'm usually a big skeptic of a lot of goodwill on the balance sheet, especially the goodwill to asset ratio. If we're going to look at the ratio for UnitedHealth, we can see that it's relatively high. I strive to roughly 20% and below. And if we're going to look at the UnitedHealth one, we can see that it's been relatively high. It's right now, the latest 12 months is 35%. It's just too high for me. In 2015, it was 40%. We do see a decline here. But again, 35% of goodwill to assets ratio, that's a lot. And I prefer to see 20% or below. So it is something you need to keep an eye for, because if impairment happens, it's going to hit earnings. But again, it doesn't happen that much. But we do need to, keep a close eye out on it. Another thing on the balance sheet I want to bring up to your attention is the unpaid claims. So this is exactly what it says, unpaid claims. So claims that UnitedHealth still has to pay to people holding their policies or waiting for some type of compensation for anything insurance related they have gone through. So what you do want to look for in these unpaid claims is their days claims payable. So I've looked through the earnings for UnitedHealth, and their days claims payable improved to 45.5, that's days, compared to the 47 in the fourth quarter of 2024 and 47.1 in the first quarter of 2024. So the days claims payable it is getting smaller. It's taking less days for them to pay the claims, and that benefits them from relieving some stress off the balance sheet. So again, that's very good. I do want to point this out to you because some of you might see this increase and think like, well, what's happening? They still need to pay a lot of cash. Yes, they do. They are decreasing the amount of days it takes, and that's going to relieve some stress off their balance sheet in the long term. We do want to see the days claims payable outstanding to keep decreasing or find stability somewhere. If they keep increasing and the unpaid claims keep increasing, then we do have a worry on our hands. But as of right now, it's looking fairly healthy for a insurer. So right here, we can see all the debt that UnitedHealth has taken on. And as you can see, it has grown substantially. It's currently growing at a CAGR of 11.82. So that's very fast growth in their long-term debt. So if we look at their balance sheet in a complete picture, I'll scroll up here because my face cam is in the way. As you can see, they have a very robust balance sheet. They have 310 billion in total assets right now. If we scroll down a little bit, they have 205 billion in total liabilities. Most of their liabilities, as you can see, comes from their long-term debt. The debt they're taking on is used to do acquisitions. If you can get fairly cheap debt and do acquisitions that have a high hurdle rate, then it's pretty common to take on the debt. A lot of their debt is with a fixed interest rate of, it ranges between 0.5 to 6.5. So that's overall pretty cheap interest on their debt because the rates of returns on their investments, according to them, are higher. So if your interest on your debt is 6.5 and you buy something that is going to generate you 6.5, then your net doesn't create value. But if your interest is 6.5 on the debt you have taken on, and the return, annualized return on the company you've acquired is 11%, there's value creation there. Because you borrowed debt relatively cheap to the annualized return you're getting from that company. So overall, pretty good. They are using debt also to finance their repurchasing of shares. I am not skeptical about it, but I would like to see it being financed another way. But again, as we can see here, they have a very robust asset sheet and a very robust liability sheet. All in all, I'm not really worried here on this aspect. The interest they're paying on their debt, yes, that is a little bit of a burden, but again, it's 1% of their total revenue, so I'm not really worried there. If it is going out of control, it's going to take up 3, 4, 5% of their total revenues. We are having a different conversation, but right now they have a very robust financial position, and I'm not really that worried about the way they're using their debt. The debt they have used with Optum and all these other things, they've taken on a lot of debt to improve efficiency. I think it's a good way of using debt, and they have managed their debt very well. So here, there's no complaining from me as well. So right now, we're looking at the segments for UnitedHealth. We're going to be looking at risk-based commercial domestic individuals served and fee-based commercial domestic individuals served first. So risk-based commercial is people in the US covered on their health plans where the insurer like UnitedHealth takes on full financial risk. And the fee-based commercial is people covered on their plans where their employer pays the claim and the insurer is paid a fee to manage them. I am reading it off because, again, I'm not an expert on the American health system. I'm from the Netherlands. I do know the European health system a little bit better. And I do want to provide accurate information. So if you're frightened by me reading it off a script, click away. But it's just to make sure you're getting factual information. The risk base is the most profitable. The insurer gets paid a fixed premium. So we would like to see that grow. As we can see here, risk base, it has shown growth. It went to 9 million in 2024 and then dropped to 8 million in the latest 12 months. The year is not over, so we could get back to 9 million, but overall it has shown stability across the border here. So that's perfect to see. The fee base, it's less risky for the insurer, but still generates steady revenue through admin fees. And as you can see right here, it has shown substantial growth here. So we do see overall good growth for UnitedHealth. Yes, their risk-based commercial is steady, but again, I prefer steady instead of declining. And their fee-based has been growing rapidly, and this is very good because they gain revenues from their admin fees. So overall, on these two segments, it's looking very good for UnitedHealth. So next up, we're going to look at Medicare Advantage individuals served, Medicaid individuals served, and Medicare Supplement standardized. Medicare Advantage individuals is people enrolled in private Medicare plans. That is for 65 years and plus. The Medicaid individuals are people enrolled in Medicaid plans, and those are typically low-income individuals. And Medicaid supplements are people with traditional Medicare, but taking on something extra. So if we look at the Advantage individuals served, we can see that there's a steady growth here. Year over year, more people are signing up for the UnitedHealth insurance plan here. If we look at the Medicaid individuals served, it's showing some cyclicality, but again, overall, it's showing excellent growth. Nothing to complain here. In these two segments, we do not see a steady decline as of yet. Although a bit cyclical, overall the trend is up. So this means that more people are getting on board with the insurance for UnitedHealth. If we look at the Medicare Supplement standardized, this has been pretty stable. As you can see, from 2012 all the way up to 2018, we saw growth. And right here, we just see stability, slight decline from 5 million to 4, but overall has been stable on 4 million. This here, that's stable. I do not mind. It is people buying something extra. It's the supplementing of their policies. I'm not worried that this is stable. Again, I'd rather see it being stable than see a continued trend downwards. In both the other segments, we do see a steady increase. As people are getting older, more people are going to need insurance. So I do think that the Medicaid individuals of 65 plus years and older, I think this will continue to grow since people are getting older and people do need that insurance, especially when you're older. So overall, on these segments here, these four, the Medicare, the Medicaid, and the Medicare Advantage, we see overall good growth, except for the supplements, of course. So people are taking on more insurances and UnitedHealth is getting more revenue from this. Lastly, we're going to look at Optum Health consumers served. So with the Optum Health, you have all the different segments, and we can see overall it has shown significant growth. We do see in 2023 that there's a slight decline from 103 million to 100 million. And as of the latest 12 months, it's 99 million. As of right now, all I see is a uptrend. Yes, the latest years have been showing some deceleration, some decline actually. I'm not worried yet. UnitedHealth has a lot of subsidiaries, very complementary to each other. So I do think if we see stabilization or growth again, that would be fine. Or if we see stabilization, that would be fine. If we see growth, that is something I do expect. Then that's just nice to have with us, of course. We would love to see growth. But overall, right now, there's nothing to be worried about. Overall, year over year, except with the last couple of years, we have seen steady increases in the Optum services that are being used. And since the insurance of UnitedHealth is very complementary to Optum, it's very integrated with each other. It's a vertical acquisition, a vertical integration. I think that it will boost growth on both sides for Optum and for UnitedHealth. So again, here in all the segments, it looks very, very good for UnitedHealth. Next up, we're going to look at some of the risks associated with UnitedHealth. So we got this article right here from The Guardian. UnitedHealth Group shares plunge after report on Medicare fraud inquiry. The U.S. Department of Justice has been investigating the health insurance giant since last summer, the Wall Street Journal reported, citing unnamed people familiar with the matter. Earlier this week, the vast healthcare firm announced its CEO, Andrew Whitty, was stepping down from personal reasons and has suspended its full-year financial outlook due to higher than expected medical costs. UnitedHealth, they did respond to this. They said, "We stand by the integrity of our Medicare Advantage program." So this program is a U.S. government-run program, as it says right here. While Medicare is a U.S. government-run health program insurance for older and disabled people. So it's government run. So if there is any fraud here, I do think that it will cause some significant impact for UnitedHealth. As of right now, it's all accusations. But again, as a quality investor, as you and I are, if there are fraud allegations, I am waiting on the sidelines until these allegations have been cleared. A fraud, it's not a nothing allegation. The US Department isn't suddenly just going to throw fraud accusations at any company out there. So I really do think it is something we need to keep our eye out on. Fraud isn't a joke. If there is fraud, I would stay away from the business. I always recommend to not invest in companies that have done fraudulent activities, because if they've done it once, they can do it again in later again. Andrew Whitty is the CEO, but the next CEO, his name is Stephen Hemsley. The CEO switch doesn't say anything. It's a culture within UnitedHealth. If they've allowed fraud, I don't think solely a CEO switch could prevent any future fraud. So if fraud did happen at a company, it would be wise to just avoid it. But as of right now, it's an accusation. They're investigating it, and we just have to wait on the sidelines to see what the investigation will say and if UnitedHealth will be cleared or not. But as of right now, I'm staying away from UnitedHealth because of their fraud allegations. But there is one more thing that really it was pretty heinous to read, actually. We're going to go over it. The next article, the next risk with UnitedHealth is, as you can probably read by the headline here, UnitedHealth secretly paid nursing homes to reduce hospital transfers. My skin crawled when I read this, especially with some of the results of this reducing of hospital transfers. We're going to read here. UnitedHealth Group, the nation's largest healthcare conglomerate, has secretly paid nursing homes thousands in bonuses to help slash hospital transfers for ailing residents. Part of a series of cost-cutting tactics that has saved the company millions, but at the time risked residents' health, as the Guardian investigation has found. Costing your cuts, I praise it, but do it in an ethical way. If you're doing it in an unethical way, you're playing with people's lives, and we'll read in a little bit also what kind of effect this has. Those secret bonuses have paid out as a part of the UnitedHealth program. The company owns medical teams in nursing homes and pushes them to cut care expenses for residents covered by the insurance giant. In several cases, and this is truly, my skin is crawling again. In several cases identified by The Guardian, nursing home residents who needed immediate hospital care under the program failed to receive it after interventions from UnitedHealth staffers. At least one lived with permanent brain damage following his delayed transfer, according to a confidential nursing home incident log, recordings, and photo evidence. This is unacceptable. If it's an allegation. Keep in mind, it's an allegation. It is people claiming things, so it's not yet said to be true. But if it's true, I would stay miles away from UnitedHealth. I praise cutting your costs. I truly do, but I want it in an ethical way. I do not want massive layoffs, leaving people without jobs. That could be, I find that a little bit unethical. If you are going to do layoffs, you need to, in my opinion, announce them. That gives the people the room to look for another job without one day being without a job and then standing on the street. But in the case of UnitedHealth, they are cutting costs on trips to the hospital. And this is causing, according to these allegations, is causing brain damage in one of the patients. This is life-altering. Brain damage, I don't know in what form it is, but brain damage is life-altering. It impacts your everyday. It doesn't matter what you're walking, talking, eating, moving. Everything you do is controlled by your brain. Having brain damage because your insurer said, yeah, you know what, we're just going to pay the nurses to not have you transferred. We're going to give them a bonus so we can cut our costs, cut our expenses. Yeah, no, that's just unethical, in my opinion. I think there's way better options in cutting costs. Maybe they should look at their risk portfolio, maybe start there, and maybe look at what roles are actually needed within the company. Maybe management could, give away some of their immense compensations, because United Health management is getting compensated richly, very richly. If we look, for instance, at the, I have it right here. If we look at the compensation, Stephen J. Hemsley is becoming the new CEO. He was the CEO from, I think, 1997. From 2006 to 2017, he was the CEO. He stepped down. He had a great performance at the company, by the way. He spearheaded the Optum part of United Health. Did billions in share buybacks. He did the vertical integration. So very good CEO. But if we're going to look, they are taking him on with a 1 million yearly salary and a 60 million equity bonus that vests in 3 years. For the coming 3 years, he's not going to get more equity, but again, you already got 60 million in equity. But other management is also getting compensated extremely richly. So maybe look there, or just look at other things. But I think the best thing they could do is look at the risk they're taking on with their policies, and the policy benefits, the poly premiums, they're getting from it. Because as we saw, the premiums to policy benefits ratio is declining. So it's showing worsening underwriting, worsening risk management. I think if you look there and you start to really increase that ratio from premiums to policies, I think that these kind of drastic measures, if it's true, illegal measures are not needed. I think it's illegal to do this, but again, there's so many different ways to optimize the business and cut costs without impacting anyone's life, like that happened to this gentleman or to this woman, causing brain damage. So there's significant risks here. I think the fact that there's a fraud case going up against United Health, I think that is enough reason for you to just stay away from this business for now. It is not contrarian to go into United Health right now. It's not. You're an absolute fool if you take on unnecessary risk, and this is unnecessary risk. I see a lot of people on X going full in on United Health. Why? Because it dropped in price. It's a low PE. But then again, you're investing in a company. If it comes out true, that is, it's unethical. You're not going to cut costs with rights to hospitals. You're not going to commit fraud if these things are true to come out better. So again, for now, I would just avoid it. We are going to go over evaluation. It's going to look very cheap, I know for a fact. But I do want to urge you now, do not invest in companies that have fraud cases running against them. People argue, yeah, but if I get in right now and it seems that or it's proven that they're not fraudulent in any form, I'm losing a lot of returns. You could be, but what if they're fraudulent? It's you're taking on a lot of risk by investing in a fraudulent company, a risk that can easily be avoided. Just don't invest in what could be a fraudulent company, It's just unnecessary risk. Why would you add so much risk to your portfolio? It's your capital. You worked hard for your capital, so don't put it at risk like that. But with that said, we're going to go over the valuation for United Health. So right now we're on my spreadsheet. This is a discounted cash flow. So we take the previous year of free cash flow, we adjust them for stock-based compensation. It's a non-cash expense. We subtract the stock-based compensation from the free cash flow to get the actual free cash flow for the business. We implement the cash and cash equivalents and their total debt and their shares outstanding. I use a 3% perpetual growth rate and a discount rate of 10%. I see the discount rate as a required rate of return. Other people, they implement the risk-free premium, the beta, they implement all these things. I usually just stick with a 10% discount rate depending, because I usually invest in quality business. They're very mature or in their late growth phase as of right now. So a discount rate of 10% usually is fitting. But again, this is what I do. Don't just blindly follow me. So I use a growth rate of 9%. Right now, UnitedHealth is growing its free cash flows with a CAGR of 12.76%. This isn't really accurate because it's missing some things. And the CAGR calculation in my spreadsheets is never correct, but I'm looking at FinChat right now. They have, if you want to use it, by the way, link in the bio. They have the CAGR open. And right now they're growing at a 12.76% with their free cash flows. And it is expected that they'll grow roughly in the same period, which I'm forecasting in the 10-year period, that they'll grow by roughly 10%. I think that's still a little bit optimistic. I think 9% year-over-year growth for the coming years, I think that's more reasonable. Their free cash flow margin isn't expanding. Their free cash flows have been very stable. So they're definitely not going to outgrow the CAGR they're growing at right now. So I do not think they're going to grow faster than 12.76%. There's a lot of risk to the business. Their risk in their premiums and policies is getting worse. So I think at the top line, there's a lot of trouble, or not a lot of trouble, but it's the risk management is getting worse. So I think it will impact the bottom line, and that's the free cash flow. So analysts expect roughly 10% in that time period. I'm a little bit more conservative. I do think 9% is more fitting for UnitedHealth. As we can see, currently UnitedHealth is at $301.69. Let me check if that's, it's $302.98 right now. Using the discounted cash flow, we get a fair value of $506.04. I am including a 25% margin. Usually I do a 15% margin, and they would get $460.79. But then again, there's a lot of risks associated with UnitedHealth, so I go for a 25% margin of safety. We get a $430.62 price, fair price for UnitedHealth. So as you can see, like I mentioned, UnitedHealth is looking dirt cheap right now. If we can either lower the margin of safety to, let's say, 30%, still cheap, 35%, still cheap, 40%, still cheap compared to the price right now. Let's do, is 50% possible? We could even do a 50%. Let's go with 70%. 70 is a little bit too much. Let's go with 65. So right now, roughly you can get in with a 65% margin. I told you it looks extremely cheap, very cheap. But then again, please remember the risks I just mentioned. It has a lot of risk to the business. There's a lot of accusations on UnitedHealth. So that could impact the business. If not the fundamentals, then the image of the business. So even if you can get in with a 65% margin of safety, just avoid it. Until everything is cleared, just avoid it. And people saying, yeah, but I'm leaving returns on the table. Yes, but you're adding heaps of risk for those couple percent returns. So just wait until everything is cleared and you can get in. I did see people mention that, yeah, insiders are buying. Again, yes, everybody says, yeah, they're buying for one reason. Usually that's the case, but usually those companies do not face fraud allegations. I mean, look at Enron, Wirecard, a lot of fraud, insider buying. Just don't. If there's fraud, just stay on the sidelines. There's so many other opportunities in the market right now you can capitalize on without taking on the unnecessary risk that comes with UnitedHealth. But that's just my personal opinion, okay? Everything here is my personal opinion. It's a wonderful business. If we look at purely the fundamentals, ethically, I do not think it's a wonderful business. I think it's awful if these accusations are true, and I would just never look at the company again if proven to be true. Fundamentally, the business is very strong. It has a very robust balance sheet. Again, the risk management part from their policies, the premiums to policies could be better, but still it's above 1, so that's good. They are growing their investment portfolio, giving them more interest and more dividends, so that will attribute to them being able to be more liquid into paying policies. So overall, fundamentally, it's a very good company. Also, if we're going to look at the margins for one quick second, as you can see also by the margins, it's very stable here as well. So fundamentally, it's a very strong and a very robust business, doing acquisitions that are complementary to all their other products, doing vertical integrations, operational efficiency at its finest right there for an insurance company. You know, you can't expect operational efficiency like a Meta to be seen on an insurance company. But again, it's very stable and it's a very robust balance sheet. It's unbelievably good. I would invest in this company if the company did not underwent this unethical types of doing business. Again, if it comes out to be true, I'm never looking at this company again. I would just avoid it. Even if it doubled, I said this on my Twitter, even if it doubles, even if it triples, I don't care what it does. The fact that if proven to be true, it underwent some unethical ways of working, I would just rather avoid it, especially with fraud and paying bonuses to avoid hospital trips. I think that's very unethical. I do keep an ethical part in my investing. This is not part of it. But that, again, is all my personal opinion. Do with it what you want to do. This is just my personal opinion, okay? I'm not investing in this company. Even though it's dirt cheap, I'm staying away from it. With that said, I truly do hope you enjoyed this video. It's a little bit longer. We're already very long in the video. If you made it this far, let me know in the comments by saying the word pineapple. Let's just say pineapple if you made it this far. I hope you enjoyed the video. Leave a like, also subscribe if you're new, and I hope to see you in my next video.